is there any reason for us to believe that we're not going to end up with 13% private equity, 13% real estate, and somewhere between 10 and 15% fixed income?
Well, I mean, it's a very good observation. I think you're right. My point is that I think there's room, given the minimums that are in place and the maximums and the interplay that you've observed, there's room to marginally change the portfolio. Will you end up in the exact same place?
That's not what I'm asking.
But will you end up in the exact same place?
No.
You may or may
No,
not.
what I'm asking is, are we going to end up on fixed income, real estate, and private equity where our minimum is
And
on
maximums.
minimum on fixed income, maximum on that, and if so, what I'm saying is, obviously, there's a way to alter our allocation compared to what we have now, but that decision would be made then today by choosing the ranges. That's the question I'm asking.
Well, I think, yeah, but Paul, I think the character, I think in the PCA assumptions and the minimums that we are assigning, the character of when you aggregate the fixed income, because we don't call it fixed income like Chris mentioned, that when you look at the aggregation of the fixed income investments across the portfolio, it might look quite different than what you have now. So you might hit a minimum, but it might be a lot of long treasuries and a lot of credit.
No, but then
For example.
wouldn't it be then, again, in your case, then I'm saying, wouldn't it be 6% liquidity protection and 4% credit?
Well, there's fixed income elsewhere in the portfolio. There's fixed income in real return. There's fixed income in the crisis risk offset or risk management offset class that we have modeled as well.
You just told Tom that actually, though, that mapping from one asset class to the other was just those two categories. So I'm just talking about,
No.
no?
Fixed income is under our definition. There is no. If you look at our major asset classes, you don't see the words fixed income anywhere. It's the underlying classes that represent the fixed income, and the underlying subclasses are sprinkled all across those classes. They're in real return. They're in risk management solutions. You'll see long treasuries. Then you see credit, and then you see principal protection, which is intermediate bonds. So when you put those all together, the nature of your bond portfolio might be different.
I think you're getting a little too into the weeds compared to the question I'm asking. Let's take fixed income out of it for now, okay? Or maybe I should direct it to Steve and Mika, because they haven't changed the categories. But is there any reason to believe, is there any substantive material reason, to use a phrase we use in the investment world, is there any material reason to think that we're going to come out with an allocation to real estate and private equity other than what our minimum is? And maybe I'd like somebody else, because I respect what Neil, but maybe Chris,
Chris
maybe.
wants to jump in, so
yeah.
I'm gonna grab Chris, and then I'll let Nika and Stephen weigh in, okay?
Yeah, I think the reason
Chris.
Neil can't give you a yes or no this time, because remember, the past 7 studies, I think he and I could have given you a yes or no answer. We don't know this time because we're modeling more things. So I would say with a high degree of confidence, yes, it's going to hit the max in private equity. I'm 95% sure it's going to do that. And remember, we're going to show you an efficient frontier, a curve of risk and return, and you get to dial up and down that. Paul's recognizing you're probably going to want to shoot for around 7.5 and above, so that's going to be a certain part of the curve. It's going to want a lot of real estate, but we don't know for sure it's going to want all of it because it's got some of those other asset classes now it can look at. And in the 2 different scenarios, it's probably going to want, it might be off by 1%, 2%. It's going to want a lot of the real estate, but I don't know that it's always going to hit 13. And similarly, it's going to want to minimize fixed income. So you're right there. And that's why I want you to be aware that they've got 15, they're around 10-ish. But depending on where you are on how much risk you want to take, it's not going to always go to the minimum. It would bound, in Makita's, it'll probably, you're right, 15 is the limit. But I remember last time there were a couple of cases where it went to like 16 or 17. If you were really worried about short-term volatility, then it would put some there. The same problem again, Paul, is the fact that we've got more categories. I haven't run one like that, so I just can't tell you for sure. Your sense is pretty darn close. We're not picking, I don't want to go on record as saying, yes, you're picking that private equity and real estate are at 13 and fixed income is at 15. You are picking the private equities at 13. And we've debated it with Mike Moy, with PCA, Makita. We don't think we could put more to work in that area in the next 4 years effectively. That's about the most we think. It'll be hard to even stay at 13. I think you're picking somewhere near the minimum fixed income and somewhere near the maximum in real estate. But to say the actual number, I want everybody on the board to realize in the asset allocation model, we're only talking about 1 or 2% shifts. We're not talking about big, broad, 5% moves. But Paul, I guess I give credit to Paul's point. Yes, the constraints, that's why we wanted you to know. Normally constraints would be a boring thing and who cares, but this really, you're limiting the model and he's recognizing in some cases, that's pretty much the model's going to bump up against that boundary. And so you're saying already, we're going to hold private equity. If we ran it unconstrained, the model would put, I'm going to guess, 75% of the portfolio in private equity.
100.
That's great if we're an endowment at $1 billion, but you can't do it. We can't do it.
Yeah, maybe I'll start and then I'll let Steve jump in as well. I think real estate's the perfect asset class to select here. I agree with Chris that broadly private equity, given its return expectation, which if you recall from the capital market assumptions is significantly higher than almost every other asset class in your portfolio, since you're targeting 7.5, any dollar that's not in private equity and maybe emerging market equity in Makita's models, there's only 3 or 4 asset classes that get you above and beyond an 8% return. So you need a lot of private equity, public equity, emerging market equity type securities in order to get you there. So I think private equity is going to keep up against that 13% limitation. I think, though, that one of the constraints put on it, one of the things we've looked at and talked to your investment staff about is the fact that you've been hovering around 10%. It's been tough to get to 13. So that we also need to think about the practicality of investing those dollars. So while the model may get there, I think there will be some options that we look at that move private equity into a range more reflective of where the opportunity set has been. And then we'd look at what those trade-offs would be. Do you have to then be over-allocated to another asset class you're not comfortable with? So I don't think 13 will be the only option you see from us in private equity. In real estate, I think given the fact that you're looking at a variety of asset classes this time that you didn't look at in your last asset allocation study, I think you're much more likely to see a reduction there because the return expectation is lower for real estate than it is for some of the other asset classes in the portfolio. The trade-off's a little easier to make. You can look at some of these other fixed income asset classes like emerging market debt, private debt, where the opportunity set might get you a little closer to a real estate risk and return overall outcome. And so I think that you'll see some real estate possibilities that do vary more widely. On fixed income, I'm with everybody else. It's tough to see that you're going to get a lot higher. I don't see you probably picking a 25% investment grade bond target just given that return expectation today.
Yeah, I'll just add a couple of other quick things. The nature of the private equity constraint and the real estate constraint is different than the nature of the bond constraint. The private equity constraint is a practical one. We'd love to model 15, 18, 20% private equity. The reality is the numbers that come out of that aren't going to be realistic because between now and your next asset allocation review, you're not going to be able to put enough money productively to work to get your existing 10% allocation above 13%. So that's as high as, after discussing with staff, we could practically model it. That being said, from an efficiency standpoint, yes, the model will point you towards the 13%, but you can certainly still get a 7.5% return with private equity allocations much lower than 13%, and we'll show different ways to do that. They just won't show up as mean variant efficient as the 13% allocation. So it's a binding constraint from the perspective of choosing a mean variance efficient portfolio, But if you choose to make a philosophical decision that you want less money devoted to illiquid asset classes and give up some mean variance efficiency, you can certainly do that and still achieve a long-term 7.5% return. The bond constraint is philosophical. It's saying as a board that we might be able to get to more technically efficient portfolios with an allocation to fixed income below 15%, but we have to recognize that the models probably don't give us a perfect sense of how severe a downturn could be in the market. And at some point, we need to protect the fund with a certain amount of assets in safe fixed income instruments to mitigate the downside. Because all of the other asset classes on here that will model out being somewhat less risky than equities, they won't provide with confidence the degree of protection that investment grade bonds would be. So the 15% bond constraint is philosophical. It's essentially telling the model, push us as aggressively as you want. We're going to keep 15% in a really safe asset class just to make sure that if there's a repeat of 2008, our returns are moderated somewhat.
So I think, Steve, you got to where I'm sort of thinking about this, which is if we know then that we're going to get to 15% or whatever our low range is, or close to our low range on fixed income, if we're concerned about the downside risk, it would be interesting, I think, in this process, and I'm not sure how we do it or when we do it, to see what the trade-off is between, if we were at 15% versus 20%, how much expected return do we give up versus how much downside risk do we pick up? And that's the question I would like to have an answer on.
Yeah, and that you'll see that in September from
We
both
will,
us and
okay.
PCA and staff.
Okay, good. Thank you.
All right, let me get so we've got Harry.
So Paul's last point is really kind of along the lines of my thinking, which is I'm having a little difficult time consolidating it and getting it concise, but it's along the lines of what Paul was talking about, is really understanding the trade-offs and what they are relative to the being in whatever the maximum and minimum ranges are. And in this case, talking about fixed income. And on page 4 of the write-up, it says, fixed income assets is a reflection of the important role that it serves as a consistent source of diversification to many other asset classes. Now, historically, that's been the case. But has that been the case in the most recent past?
I'll
As
take a
serving as a
take
diversifier?
a stab at that. To Chris's point, the correlation between bonds and stocks has varied quite widely over time, and at some times, bonds and stocks are correlated very highly. In severe market downturns, in significant global crises in the markets, bonds have always served as a protector. So in the
You're parking a higher percentage of capital in fixed incomes when fixed income returns aren't generating the types of returns you're assuming, you're therefore, that's one of the trade-offs, right? You're missing out on, you're missing on the
That's
upside
right,
as well.
absolutely, yeah.
So I
yeah.
think it's important that that be
Of course, yeah,
placed on the record as well. And my curiosity is around the area of new asset classes or are other like-minded or similar institutional investors, not the endowments because their liabilities are very different, as Mr. Ailman pointed out, but are there other global institutional investors that are looking at alternative asset classes that in the short term don't necessarily have the history of fixed income, but have similarities to fixed income-like returns that would provide diversification, but are not under the traditional fixed income model? In other words, are institutions looking at other asset classes and saying, we're not going to park 15% of our capital in a traditional fixed income place because we're giving up too much, and we're not going to get to our 7. It's going to be very difficult to get to our 7.5 with these returns. You're looking at me as if you don't make any sense, or you're looking at me like I understand what you're asking. Neil?
Number one, in a crisis, it's very hard to replace what fixed income can do for you. But your concern is, how do you manage the journey? How do you manage the potential for downside risk over the course of the next 30 years? And for example, other plan sponsors are looking at options-based strategies and equities to try to mitigate the volatility that equities produce while maintaining the return. So if you look at the schematic, we've introduced, in dialogue with staff who've been testing this out, 25% of your global growth class includes these types of assumes that these types of strategies will be implemented over the next cycle, assuming you get allocations there. So there's a place where new strategies are being introduced into your mix to address that kind of concern.
And just to add on to that, I think that all investors right now are given the 6 years of a bull market that we've seen, given the 7.5% to 8% expectation that most plans are striving towards, but the real concern about another economic downturn or a market downturn, I think everyone's trying to find strategies that don't give up too much of the upside but can protect you better on the downside. So to Neil's point, in the equity markets, you're looking at low volatility type equity strategies. And within this risk mitigating strategies component of your portfolio, that's where I think some other more hedged portfolios, trend following, some other types of unique investments might be included in this that you haven't necessarily invested into a large extent in the past. From our perspective, from a modeling standpoint, a lot of that's more implementation based and strategy based than it is a model that we put into the optimizer to help you decide how much goes into global equities. So we think that you can pick specific global equity mandates that might reduce volatility without giving up upside and not change your expected return.
Mr. Tom?
To address your question, Harry, and just to add to the comments that Neil and Mika had made, the innovation program, that's exactly what we're trying to do, is that we're trying to look at strategies that will help address really the drawdown of the portfolio, minimize the volatility, but without degrading the overall expected return for the portfolio. So the strategies mentioned, low volatility and cover calls within equity, exactly what we're trying to do is that we're trying to reserve the equity return, but to see if we can dampen somewhat of the volatility or drawdown within that asset class.
And the final question, just in terms of the appropriate place for a discussion around this, where it would take place, if it takes place at the board level or not, is the global equity bucket. And we know how it's been tilted the last 6 or 7 years. And I'm confident the appropriate people are having conversations about what that should look like going forward. Should we have that same type of tilt that we've had? If that's going to change, when and where do we have that discussion? And does that come before this committee, or is that something that's done really within the staff and the consultants?
No, it's going to come back to you because your policy, your global equity policy puts a hard code of 2/3 allocates to the U.S. and 1/3 to non-U.S., including emerging markets. I said it last month, and I want to really emphasize it. The capital market assumptions we adopted, these models are going to favor non-U.S. stocks. So they're going to come back already probably with at least a 50-50 U.S., non-U.S. allocation. And if you notice at the very bottom, INV 20, the last part of the table under Makita, they limited the amount of emerging market equity to 25% as a percent of non-U.S. equity. Right now, we're at, what, 10% EM? Within all of non-U.S. Yeah. So that's like double, 2.5 times our current allocation to emerging markets. Those are big issues we'll all want to talk about. But I can already tell you, just like Paul said, looking at, kind of a sense of having done this before, the model for both, the curve for both funds is going to really favor emerging markets. It's going to favor non-U.S. And be really different than the way we're currently invested. So normally what happens is you guys would, you'll debate about the curves, where you want to be up and down on the efficient frontier. That'll result in an asset mix. We'd debate it, kind of finalize it, or come to hopefully some conclusion in September. You'd adopt it in November. As part of that, we'd come back in November with a plan of attack. The biggest shift you ever made was a 5% shift from 3% from fixed income and 2% from global equity, 5% to a new place. We said, that's probably going to take 4 years to 5 years to implement. So we'd come back and say, wow, here's the fallout from the asset allocation study. Maybe obviously risk mitigation, a new asset class, new subsets in fixed income. Here's where we are now. Here's how long it will take to get there. But Harry, you raise a good point. It may still pick, say, 55% in global equity, but the percentage weight in global equity could be radically different. And you already have, as a committee, the goal next year of studying the investment beliefs, but we'd have to find a way to wrap that in and come back to you and say, okay, we really, are really comfortable believing the model and getting rid of our home country bias. Are we really comfortable? I've told you before, you have some really conflicting, when it comes to emerging markets, the constraints we want to put on the ESGs, boy, that's really where the rubber hits the road. I don't have a good analogy, but that's where the conflicts come up. Emerging markets is just fraught with ESG problems. How do we balance that? And there aren't a lot of ESG, not a lot of emerging market managers out there, and certainly not some that give lip service, but not a lot that we say are really hardcore ESG focused managers. So there'll be those kind of constraints we'll have to debate. I think it'll take longer to implement this asset allocation mix that you pick, that's my guess, than it has been in the past. Sometimes we're able to do it within a month, but this one might take 2 years to get chugging in the right direction.
Can I, go ahead. No, please. I was just going to jump in with a quick reminder that one of the big differences that you'll probably see in September is that Makita will still, although we're showing the public equity minimums and maximums here, that EM equity is a component of that restriction, but Makita still shows and models US equity, EFA, and emerging as 3 unique asset classes. So you'll actually see explicit targets. That was kind of that 1-step versus 2-step discussion that we've had over the last few months. So from the standpoint of how our proposed potential asset allocation options might look relative to kind of that next phase discussion that Chris was mentioning.
And I don't want to get into the weeds. Sharon, I'll pass it back to you in a moment. Sure. I do think when you do come back to us, I think a tighter conversation about emerging markets really we need to be explicit. That's a term that's huge. It's a huge term. So what does it mean? Anywhere else but the United States? Does it mean Brazil? Does it mean China? Those are all emerged, right? Those are economies that have emerged. Growth markets, or I've heard it talked about as growth markets. Population growth, GDP growth, places like that. So I think a little tighter definition. Clearly, we don't want to get into the details of what you and the staff needs to do. But I do think it's important for this committee, and for when you're speaking about emerging markets, you might be using that term. I might think of something completely different than a colleague of mine on the dais. So I think we just need to be tight about what the definition, your definition is. Yeah. Thanks.
Yeah, thankfully, the one area, Harry, in that area, just so everybody's put some comfort to you, the index providers that we use, whether it's London Stock Exchange, FTSE, or Russell, or the MSCI index, have very tight boundaries of think of sub-Saharan Africa, those are frontier markets. Greece, Mexico, Korea, South Africa, those are emerging markets. And then obviously Canada, UK, Germany, France, developed markets. So we have really good, clean cuts. It does get confusing if you look at fixed income, which divides the world even more differently. But we'll stay with the equity definition and help you along with that.
Fixed income, Tom.
Okay, actually, the thing I was going to comment on before this sort of passed, but I think we're on the subject that's probably I've given the most thought to, which is how, what level of responsibility and guidance should the board be giving to staff in terms of asset allocation? And there's some questions that, as Paul's pointed out, just kind of answer themselves. You can only access so much high-quality real estate and private equity over so much time. You can only exit or move out of those in so much. fixed income questions, pretty much, the logic is pretty controlling these days. And the two questions that seem to me to be most significant is you focus on our equity portfolio, our public equities portfolio, are one, the emerging markets commitment, where I at least personally think we have to be very explicit, we as a board should be explicit on. And because that's a major policy decision. And the other is, as Chris pointed out, the home country bias, which I gather really, it affects our public equity portfolio. Also, it affects our need for, if we shift away from it, currency protections and other things like that. Those are the two things that I think we as a board have to do, should get to a level that we're doing differently this time as opposed to last. Maybe we'll learn a little bit more about risk management strategies over the next allocation period, but we're not yet ready to jump in with billions of dollars. At that point, I haven't heard. So it's those two questions that I think we need to bring to the fore, and it seems to me our asset allocation choices have to be rationalized with our equity investment policy that we have, so that we're not adopting an asset allocation in November and saying, okay, now we have to start a policy review process that'll take another 9 months and take us to the end of this asset allocation study. So we have to, I think, in parallel, rationalize the asset allocation in our investment policy. Those
are good comments, Tom. Thank you. No more questions from the board, so we can. I don't know where we're at now, Josh. If you're finishing your comments, or
Excuse me. I had
go
one
ahead,
other.
Tom.
The point I wanted to make earlier was, it seems to me that if we see what the model is producing, given these constraints, and that we're not liking the results, we can, of course, okay, let's look at different constraints. And I think it's important that we think of this as a potentially iterative process, and not think of, okay, this is carved in stone.
Right.
As a result, this is what you've got to do.
So let me just check in, because this is an action item to adopt the constraints. And so my question, and then Chris, jump in after me, is to Tom's point, can we go ahead today and adopt the constraints? And then obviously in September, you've heard the comments of the board in terms of looking at upside, downside, fixed income, and then we have the freedom to modify constraints based on information in September, even
Yes, that is
as we've
correct.
adopted the
I was
action.
going to remind Tom, I think he was the one that did it, or Paul did it last time we did it. We presented the curves, and you guys said, let's come back and look at tightening. We added a constraint. So yes, you can.
So my question is, what does it mean to adopt them?
Right.
Just to make sure the consultants are, you know them, we're all on the same page, I guess, Tom, is the best value. Ultimately, what you do approve does go in your policy, but it's just to make sure the consultants are all using the same thing and you agree with that.
Okay, so I'm ready to move forward, but I've got Paul in the, okay. So let's go ahead and move forward. Thank you, Mr. Vice Chair. Let's go ahead and move forward then as an action item. Anything else? So,
Can I just
sure,
get
yeah,
clarification?
sure. Paul,
So, the staff report says we recommend adopting what's in the consultant's reports. The consultant's reports say we recommend adopting what's in the staff report. And so I'm just trying to make sure I understand what we're adopting. What we're adopting is the recommendations of PCA for PCA's running of their model, and we're adopting Makita's recommendations for when Makita runs their model. Is that right?
and my understanding is all the information on INV 20, right, Josh?
That's correct. Yeah.
So if everyone looks at INV 20,
Got it.
Table 1 and Table 2, because remember, we're kind of doing this in let me just finish. So we're running these in parallel, right? then we're adopting PCA's constraints and Makita's constraints. Staff has opined, there's been dialogue. That's what we're choosing. Yes, Tom, go ahead and, punch in, Tom. Oh, nope, I lost you.
So, but really what we're just saying is, okay, we understand what you're starting with.
Right.
And so I don't see the need to say we've adopted anything at this point. We know where you're starting, and the end product is, and it's two different universes. And the end product is gonna be your model that we may ask you to tweak. So, I mean, this seems like a
Right, to my mind,
non-action.
it's just us as a board saying, we're saying, go ahead with these constraints for our two consultants. And then with the understanding that in September, with the information we get back, we can make modifications. That's, I mean, I guess we don't have to make it an action item, we can have it be an informational item. So that's the purview of our investment committee, so let me grab Dana and then Paul, hang on.
Move the constraints on IMV 20.
Second.
Okay, so it's been moved and seconded, discussion. Paul?
Well, I just want to make sure that while we can go back and change things, as I recall, because these are, a Monte Carlo simulation with thousands of runs, it's not real time that we can change them. Right? So it's not like in the meeting we can change them. We're gonna be able to see a range of outcomes that are within the constraints, within these constraints. But at that meeting, we're not gonna be able to see a range of outcomes outside of those constraints. So if we wanna look at a range of outcomes outside of those constraints, we're gonna have to ask them at the meeting to go back, run it again, come back again.
That's right.
Which we can certainly do if we don't like any of the options that we see. But it's the starting point for the conversation we're going to have, because anything outside the constraints, we're not going to be able to have a conversation about at the meeting that they come back with. That's all.
And just to reinforce, the investment committee, we can take as long or as short of this I mean, we've planned, I think, 7 parts. If it takes 8, that's okay, right, Brian? Right? So it's, it's our asset allocation. So if we do find in September that we do want to go back, we can take the time to do that at the next board meeting, So it's been moved and seconded to approve the constraints. Any other discussion? Are there questions? Okay. All those in favor say aye.
Aye.
Opposed? Abstentions? All right, constraints are approved. Thanks, everyone. Thanks, Neil, Josh, Stephen, Mika, Stephen. Thank you. All right. Okay, interesting. Okay, so we are at item 5, annual review of delegation to staff. Chris. Do we need a 5-minute break, 10-minute break? Are people okay, or a break? Let's take a 10-minute break, and let's come back at 10 till or so-ish. Thanks.
This is an important part of your monitoring of the system. CalSTRS has delegated broad authority to the investment staff since 1997. As I said in the memo, you were actually one of the first funds to ever do that. It was uncommon back then, but now has become very commonplace. The only significant change during the year was all the way back on INV 33, and I should have underlined it. In the last column, bottom, we added the deputy CIO with signature authority in infrastructure investments. And the other thing I should point out, because we got a question from Harvey and as the new fiduciary counsel, these are not cumulative. One person can't do 100 and then somebody else does another 200 and adds up. These are limits, so that on the first page, an IO 1 or 2 can only do 15. We recently had an experience where in global equity, because the index reconstitutes on one day of a year, that's a huge trade. It's over June Kim's limit authority, so she has to have Michelle Cunningham sign the tickets. And that's what it's intended to be, a regular stop. The one nice thing is in many cases, we're getting electronic systems, so these become electronic hard stops rather than manual. But this is your chance to review them. The only other thing I would point out, and I did in the memo, many of our older delegations in private equity, the home loan program or credit enhancement, which are our programs in moratorium, are still based in dollars. Harvey pointed it out to us, and most of the time when we do internal audits, the audit committee hears a frequent, not finding, but recommendation is you ought to get off dollar limits and go to percentages of the portfolio, that is more representative. I think I pointed out in here that the delegation in private equity, when the board did it, was 5%. Just because that portfolio has grown, that now only represents 2.5%. You know, and so we'll come back and look at these. You usually look at delegations within the individual policies. We just summarize them here so that you can have a chance to step back, look at them and say, I'm comfortable with this or I'm not comfortable with it. With that, we're open to questions.
Any questions? This is an information item. And then can I just ask quickly, Harry's got a question, but to make that change from dollar amount to percentage, would that just be a,
We would bring it back as part of the policies for each of those respective asset classes. So next time, like private equity is actually going through an internal audit, but next time their policy is up for revision, we would bring that as a policy change.
that makes a lot of sense to me, but Harry?
Just
Oh,
before I
sorry,
go-
go ahead, Brian.
I would just like to instruct staff on your behalf to make sure that that clarification about the non-cumulative nature appears in written policy.
Policy right now that it's, okay. Yeah, that would be good, thank you, Mr. Bartow. Harry?
So I would just like to know the dollar amount versus the percentage, Chris. Clearly there's a difference of views, or historically we've used the dollars, and you give the example of 2.5%, 5%. Is there a benefit to it being in strictly percentage amounts?
You know,
And-
it had to do with, I think, the rapid growth of the portfolio overall. The fact that we went, you know, on one hand, when we went from 100 to 150, then back to 100, percentages would be reflective of the size of the portfolio. And it's the recognition that today, some of these were set when, say, private equity was 10 billion. Now it's 22 billion. As we approach 200 billion, we'll get into it in the business plans, but given the growth of the portfolio, the idea is, do you really, you know, does it make sense to limit it as just a random dollar amount or as a percentage? And I think that, I don't know when it changed, but it seems like the philosophy in the industry and with auditors changed to percentages a few years ago.
Might be, but
Right.
has the dollar amounts versus the percentage amount ever adversely impacted staff's decision to execute a deal and had a negative impact on something that you've wanted to do?
No, to date, no, it has not. It has just ratcheted up. There are times we have thought about, particularly in private equity, whether we needed to call a special meeting because then it would affect you. So it doesn't stop us from being in a deal, and it doesn't stop us from investing the size we think makes sense. It's just more procedural of kind of, you know, who has the signature limit, and in some sizes it's only you. So then we would, I think it was last summer, we almost called a special meeting because we were thinking about going to a larger size, but decided not to.
If I may, Madam Chair? Yeah. I'd like to ask for just an information request within this fiscal year, 15-16, have some presentation about the pros and cons of moving the entire policy to a dollar amount, to a percentage as opposed to a dollar amount. And I'd like to have fiduciary and general counsel weigh in as to the risks associated with. So just as an information item, a little bit more in detail for this 15-16 year. So it could be,
Kind of pros and cons.
yeah, pros and cons. Okay? Thank you. Thanks.
No problem. Any other questions from board members? Great. Oh, Tom.
I just had one, it's a kind of minor question. But under corporate governance, the categories are capital calls and co-investments. And is that meant to be aggregate capital commitments to a fund? Or is it any one in particular capital call? Because that would seem to be a very large capital call.
Yeah, the allocation to those funds tends to be very chunky. So it is more a daily ticket to a capital call. When we fund a corporate governance manager, I'm going to pick like on relational, we wire the money entirely to them. And then the delegation to hire or execute the contract with or invest in a partnership, well, I guess I would say it another way. The capital call is usually the total amount we put with a fund, a maximum with a fund, and the capital commitment comes at one time.
Okay, but it's not, we've made a $5 billion capital commitment and they're just calling $1 billion. Okay.
Yep.
Then I'm fine.
Great, I don't see any other questions, so thank you. Let's move on to item 6, which is our fiscal year 15-16 business plans. How do you want to do this, Chris?
I am going to follow Jack's leadership and make this right to the point. The directors are all here to come forward to answer your questions, should you have them. And I would tell you in the past, this used to be about a 3-hour presentation. I think Dana might be the one that remembers it. A couple of pages I want to highlight for you. First, INV 42 and 43. 42, again, this is just a 2/3 estimate. So I'm taking the portfolio using Milliman and PCA's prior numbers of how slow it could do and how well it could do. I think one of the testimonies of this, think of the idea that, you know, when you're trying to predict the future, if you're going to drive across the country, it's nice to have a rough road map and a rough idea. You may make course corrections, but you kind of want to know where you're going. That's what this is serving for, is how big is this portfolio going to grow? What should we do in terms of staffing and resources? It's actually worked. Even though we've had the volatility of the OOs and 2007, 2008, we actually stayed within the ranges. I moved the projections up because obviously with the funding, I would tell you if you looked at this the prior years, that dashed red line on the bottom would disappear off the charts below 25 billion. With the funding, it doesn't. Even the minimum, you know, the low return environment, if we were Japan for 2 decades, we had no GDP growth in the USA, we'd shrink, but we wouldn't run out of business. So that is a huge change in our perspective. But you can see the expected growth of the portfolio. That at least gives us a rough idea of how to manage in the future. That leads you to the business plan down below that kind of gives you a rough idea from a financial planning standpoint. The goal that we're trying to do with this is obviously we can't predict how the asset allocation will change over the next 10 years, how different management formulas may change, or we do assume some fee changes, but we're really trying to manage it in terms of the growth size of the staff, the size of the external management, and managing our costs. And clearly some of the things that jump out and have been a very big topic have been money management fees to Wall Street, which is line 7 on there. You can see that number grows. That's an estimate because quite a few of our money managers are on incentive fees. And keep in mind, this only covers the public assets. It doesn't cover the private assets. So real estate and private equity, which are in partnerships, are paid differently. This covers the contracts we have. That number could go up a lot in a given year if our managers dramatically outperformed. That actually would be good news because that means we're making a lot more money. But we've assumed some rational levels of assumptions. And the very bottom line, 17, is what we're trying to manage the portfolio within and our costs. Again, the 12 to 13 basis points, you hear us talk about costs in different ways. That's just the staff and public money manager cost. You would double that if you included the private asset classes. And then if you use the CEM methodology, that number is actually closer to about 42 to 44 basis points. So it depends on your cost methodology. But we do highlight this once a year when we talk about costs, because so many people say people aren't transparent about it. We are trying to measure it all the way down to, our consultant fees, our risk system. Maybe that's too much detail for people, but at least they get to see in this. We show it to them and you in 3 different formats, so you can see our costs and see what we expect our costs to do over time. We've used this as a very effective planning tool, even when we built the building, things like that, how we manage space, all of that type of stuff. When I jump into the asset classes, I just want to highlight per asset class. We tried to really focus it down to 2 pages. Each director wrote their own report and can explain it. Within global equity, I would say the big mandate is to expand internal management. The first move is going to be bringing a non-U.S. equity portfolio in-house. And the key to that is getting the talent and the people to help us manage that. In fixed income, we need to implement new securities lending. We selected new vendors through an RFP, but we've been delayed for a number of factors on getting those shifted, but we want to do that. And Glenn's going to keep looking at internal management, because that is a continued theme. That's the best way to reduce that lying cost of paying Wall Street fees, is that we take the assets in-house. In real estate, they got the portfolio back within the risk benchmark you set, and their goal is to continue to manage that. But the toughest thing that Mike pointed out is finding opportunities. Real estate is really fairly valued, so it's going to be a challenging year. Easy to sell stuff, but the question about what they should buy. Private equity, you've heard a lot in the papers about it, but we have an information system, but we need a much more robust one. I would say CalPERS built a lot of their press this week came out of the fact that they got a presentation. CalPERS has been trying to build an in-house performance measurement reporting tracking system for quite a few years. Major IT project for their investment office. We have state of the art, but I would tell you it's, state of the art is not all that great. And Margot and we have been constantly searching for better information systems, so we'll be doing that. And then obviously pushing on compliance, transparency with the general partners. That theme is going to be there for a whole year. Corporate governance, Ann needs to integrate the sustainability managers, already starting to do that. Paul's area, inflation sensitive. He's going to bring you an inflation sensitive investment policy. So we have an infrastructure investment policy, but we don't have an overall inflation sensitive investment policy. So he'll be bringing you that in the fall. And then his goal is to continue to diversify those assets. Right now it's just global linkers and infrastructure, and we need to look at other inflation assets. Inflation's not a problem, but we want to protect ourselves now before, you want to buy the insurance before the fire, not during the fire. In Stephen's area, he's going to, as he said in the presentation, he's going to continue to explore stuff, look at new, as Harry asked, new investment ideas, new things that other plans are looking at, stuff that people aren't even looking at. If you remember a couple of months ago, we had him put on the lab coat. He and Carrie will put on the lab coats with safety goggles and keep looking at stuff out there. And then in operations, with April in charge now, one of the goals is to really enhance our abilities. The portfolio, I would say some of our peers, when I look at APG in the Netherlands or the Canadian Public Pension Plan, the people that are at 300 to 350 billion, I guess the best picture is, think of an oak tree just sprouting with branches. I have to call them cauliflower or broccoli. I mean, it just, the proliferation of the complexity of their portfolio is almost mind-boggling. We're trying to stay fairly focused and fairly clear, but when I look at everybody out there who's bigger than us, they all have gotten more complex. There's almost none of them that have stayed simple and true. So that's going to be one of the challenges, to get operations ready to handle that. There's also, Jack brought back from NCTR, there's been quite a few plans that are looking at ways to wrap their defined benefit program as a portfolio and offer that into the DC market. I did that in Washington. It only works when you pass a law that says the value we give you isn't the real value and you can never sue us on that. It's just a number. That doesn't work, I don't think, in California very well, but there are people that are trying to do that. Wouldn't be a big impact on the investment shop, on the investment asset management side, but it would be a huge impact on the operational side. But it's something that's very worthwhile to look at and might be real attractive. So that's going to be a big challenge in her area. For me, it's filling that stakeholder position that you gave us, and with Deborah and Michelle really managing the office and continuing to get the resources in, get them filled, our positions filled, and execute on the mission. As I constantly say, June 30 was the finish line, and on July 1, it was like, okay, on to 7.5. Let's go. Start again. I have a slide that I show the new employees when we do orientation. Jack does a good speech with them, and my slide is our goal every July 1st starts at 0, and we have to make $15 billion. And so, the gun went off. We have started that next leg of the race.
All right, thanks, Chris. Harry?
Chris, where are you with filling that staff position? The board
Yeah.
directed at the offsite. I thought we were pretty clear that the board thought it was important that you fill the position with someone that deals with many of the stakeholder relationship matters. I know you've been getting some support from folks who are already in-house. Can you just provide us with some clarity as to how that's working? Because our intention was that there was going to be, we want you to be focused on that 7.5 and overseeing the portfolio and your team. It's wonderful that you're accessible to so many people, but this board doesn't want necessarily that to be your primary focus. It's nice that you want to go there and be so responsive, and we want you to be to a certain extent. So can you help us out?
Yes. No, that has been a priority of mine. It has taken time. I am pleased to say that we have spoken to some people because it's a new kind of a position that people aren't aware of. So we've kind of beaten the bushes to get a handful of people very interested in it. So we're about to post the position. I would hope that by the time we meet, it takes a while for somebody to get in, but we've talked to some outsiders that we think would be very attractive candidates. We'll post the position shortly. We have to hold an exam, then do the interviews, but we will get them in. So I am disappointed that it has taken me 9 months to get this done, but we'll get it done.
Yeah, because
Yeah, and as you point out, we're using probably about 30% times 50% of Gretchen's time up in sort of public affairs.
she's great at what she does in communications, and that's for Jack and your team to figure all that stuff out. But we were clear as to what we
Right.
want relative to what your role is. And as I've spoken to folks from outside the organization who mention you, and that they specifically, Mr. Ailman, our CIO, I'm listening, and then I get disappointed.
Okay.
Because I'm thinking to myself, that's not an issue that this board wants you to be dealing with. So I know we are
Yeah.
looking forward to the day where that position is filled and we can make clear to folks that those types of issues get directed to a specific person within the organization. I think Ms. Weir over at CalPERS deals with a lot of those issues. That's what we're looking for. That's what we expect.
I hear you loud and clear.
Thank you.
Thank you.
You're welcome.
Any other comments or questions from committee members? Great. All set, Chris, thank you. All right, Michelle, fiscal year 14-15 investment committee objectives recap.
All right, this is really intended just to close the loop on the objectives from this last fiscal year. And I think, Sharon, you did a great job this morning when you were talking about this upcoming year's investment objectives. You kind of covered some of the things that we completed last year. So I really don't have anything to add to the report, except that, and I'm sure that you're well aware, it was a very busy but productive year, and we met all of our objectives. So, and happy to answer any questions.
Great. I like seeing check marks completed. That's always. Any questions, comments? Yeah, I mean, I think it goes without saying. I just think we're so proud of our investment team, our staff. I think you guys do an amazing job, and just the clarity of what our commitments are every year, and then accomplishing them with professionalism and good performance. So I don't see any other questions. So thanks, Michelle. Thanks for your brief but comprehensive report. All right. So review of information requests. Lamont?
Yes, I had two specific items regarding the asset allocation study. There was a request from the committee to receive a sort of mapping from the consultants of the current portfolio relative to the constraints proposed, and to show the component percentages in dollars. And then on the delegation of authority, the committee would like to receive a presentation on the pros and cons of the delegated limits in dollars versus percentages, and with input from the general counsel and fiduciary counsel.
Yes. Thank you, Lamont. All right. Item 9 is our draft agenda for our September meeting.
Sharon, I have one change.
Sure, okay.
I just want to draw out, we jumped the gun a little bit, INV 73, number 11 and 14C, that would still be Mike Moy from PCA. Mike's contract runs out through September 30, and this time period that we're covering is March 31, so it's definitely squarely in his contract period. So Mike would fulfill that role, and then obviously Makita would pick it up 6 months later.
So you're talking about item 11, anything else?
11, I'm sorry, INV,
14C.
7311, private equity semi-annual performance report, and then 14C, instead of John Haggerty, it will read Mike Moy, PCA.
Comments? Great. Thank you, Chris. Opportunities for
Oops, sorry,
Chris, go ahead.
staff reminded me. We also, I neglected, under the action items between 8 and 9, we're going to add it'll be an information item, so it'll be between probably 11 and 12. We're going to add the inflation-sensitive policy. Paul listed as an objective, and he's a go-getter, so he's already ready to bring in that for a first reading. So,
Yeah, that'll be our first reading, right? Because we have an
Yes.
infrastructure policy, but not the.
but not an
entire asset
inflation-sensitive
class.
investment policy.
Excellent. Thank you. All right, opportunities for statements from the public. I don't see any. Excellent. All right. Well, thank you for members of the public for being here. We're going to jump into closed session. So for those of you who are not staff of CalSTRS, it's time for you to go home and do something fun outside of our meeting. So we'll adjourn from open session and give people a couple of minutes to clear the room, and then we'll move into our closed session portion of the investment committee.